What if I told you that the single biggest wealth transfer of this decade is not happening in rockets, not in electric vehicles, and not even in the headline AI companies everyone keeps shouting about on financial TV? It's happening in something so small you can't see it with the naked eye, and the companies that control it are sitting on the stock market right now, hiding in plain sight, waiting to explode. There's a $4 trillion infrastructure build-out already underway. Most retail investors are completely missing it because they're chasing the wrong names. Today, I'm going to give you 5 specific stocks that sit at the choke points of this entire wave. Each one collects a toll every time the AI economy takes another step forward. This took months of digging through earnings calls, capex guidance, and supply chain data to put together. If you're serious about building real wealth, not gambling, not chasing momentum, hit that subscribe button right now. We're building a community of investors who actually think before they click buy. If you are not subscribed to Stock Pulse Alpha yet, hit that subscribe button right now and ring the notification bell. Stay with me, because the 5th stock on this list is the one nobody in financial media is discussing, and it might be the single most asymmetric setup in the entire chip supply chain. Before we get to the names, you need to understand what's actually happening underneath the market right now. Because if you miss this, the rest of the video won't make sense. The AI story has moved into a new phase. Phase 1 was ChatGPT. You typed a question, it gave you an answer. Cute, useful, but fundamentally passive. Phase 2 is here. It's called Agentic AI. The AI doesn't wait for you anymore. It goes out and does things. It books the meeting, it pulls the report. It runs the analysis while you're sleeping and drops it in your inbox before you wake up. That shift sounds like a software story. It's not. It's a hardware story, a massive one. Here's why. In Phase 1, every CPU sold came with roughly 8 GPUs attached. GPUs were the entire engine. But agentic workloads are different. They lean heavily on CPUs because they're orchestrating tasks, managing memory, coordinating across systems. Intel's own CEO said on the last earnings call that the GPU to CPU ratio has already dropped from 8-to-1 down to 4-to-1. He expects it to keep moving toward parity. Translation: CPU demand is about to roughly double from here, and almost nobody's positioned for it. Meanwhile, the Magnificent Seven are spending money like it's going out of style. Meta alone is targeting around $140 billion in AI capex this year. Amazon, Google, and Microsoft are each circling the $200 billion mark. That's close to $750 billion from 4 companies in a single year, all flowing into the same infrastructure stack. The question isn't whether the money gets spent, it's already committed. The question is which companies actually receive it. That's what we're answering today. Here's something most retail investors don't fully appreciate. Nvidia doesn't manufacture chips. AMD doesn't manufacture chips. Intel barely manufactures its own most advanced chips anymore. None of them do, they design. Like an architect drawing blueprints for a skyscraper. The construction crew is Taiwan Semiconductor, and this is the beautiful part of owning TSMC. It doesn't matter who wins the chip design wars. It doesn't matter if Nvidia stays dominant, or if AMD takes share, or if Intel mounts a comeback. TSMC fabricates for essentially all of them. Every horse in the race runs through their factory. Their market position in advanced node manufacturing is more dominant than SpaceX's position in orbital launch. Let that sink in for a second. The numbers back it up. TSMC controls roughly 60% of the global foundry market and over 90% of the most advanced chip production, the 3-nanometer and below nodes that power every cutting-edge AI accelerator. Margins are running near 50% gross. They just opened a state-of-the-art facility in Arizona with US government subsidies sweetening the deal, and the chip packaging firm we'll get to in a minute built their factory 7 miles down the road. That's not coincidence. That's a supply chain assembling itself in real time. The risk? Geopolitics. Taiwan sits in a tense neighborhood, and any China-Taiwan flare-up sends this stock sideways fast.
That's real.
But the Arizona build-out is specifically designed to de-risk that exposure over the next 5 years. The action? This is a core position. If you don't own it, you're betting against the entire AI infrastructure thesis. At current multiples, it's not screaming cheap, but it's not expensive either given the growth profile. Accumulate on any meaningful pullback. I know, Intel, the company everyone wrote off. The company that missed mobile, missed GPUs, and watched AMD eat its lunch for half a decade.
Yes.
Exactly that Intel. Here's the reframe. The agentic AI shift I described earlier, the one bending the GPU to CPU ratio back toward parity, lands directly in Intel's lap. CPUs are what Intel makes better than almost anyone else on the planet. They've been sitting on the sidelines while the GPU party raged. Now the party is coming to them. The stock has already moved sharply over the past month as the market started to figure this out. Some of you are watching that move and thinking you missed it. I don't think you have. Why? Because the demand wave is just beginning. If CPU shipments double over the next 3 years as agentic workloads scale across those 90% of Fortune 500 companies Microsoft says are already exploring agentic tools, Intel's revenue trajectory looks nothing like what current analyst models assume. Pricing power is returning. Foundry losses are narrowing. The US government has every strategic incentive to keep Intel alive and competitive as a domestic manufacturing alternative to TSMC. The risk? Execution. Intel has a long history of promising turnarounds and under-delivering. Pat Gelsinger's roadmap is ambitious. If 18A node yields disappoint, the stock gives back gains quickly. The action? This is the highest risk, highest reward name on the list. Position size accordingly. Don't go all in. But a starter position here makes sense if you believe the agentic thesis. If this breakdown is shifting how you think about the AI trade, do me a quick favor and hit that like button. It helps more than you know, and it tells the algorithm to surface this kind of analysis to other serious investors. Drop a comment too. Tell me whether you're on board with the Intel comeback or whether you think it's a value trap. I read every single one. Now let's move on. AMD is in a position almost no other chip company can claim right now. They benefit from both sides of the AI shift. On the CPU side, their server chips have been quietly taking market share from Intel for years. E-Plus processors are now in roughly a third of all data center sockets. As agentic AI lifts CPU demand across the board, AMD captures a meaningful slice of that growth. On the GPU side, their MI300 and upcoming MI350 accelerators are the first credible alternative to Nvidia in AI training and inference. Microsoft, Meta, and Oracle have all placed major orders. The supply-constrained Nvidia ecosystem has created a real opening, and AMD is the only company technically positioned to fill it at scale. Revenue from their data center segment crossed $12 billion last year and is on track to roughly double again. The stock has run hard recently, but the forward multiple is more reasonable than people assume once you adjust for where data center revenue is heading. The risk? Nvidia is not going to roll over. CUDA's software mode is real, and AMD's Ryzen ecosystem is years behind. If Nvidia's next-generation architecture extends their lead meaningfully, AMD's GPU share gains stall. The action? Buy on weakness. AMD is volatile. You'll get 10 to 15% drawdowns regularly. Use them. I know what some of you are thinking. Nvidia is overvalued. Everyone owns it. The story is priced in. I'd push back gently on that. Here's why. Nvidia's revenue is being driven by the same hyperscaler capex numbers I quoted earlier. Meta at $140 billion. Amazon, Google, Microsoft each circling $200 billion. The vast majority of that spending flows through Nvidia GPUs. Until those numbers start coming down, and there is zero indication they are, the underlying demand engine keeps running. The stock has been consolidating recently, while earnings keep grinding higher. That's actually what you want to see. Multiple compression while fundamentals expand is how the next leg up gets set up. The next catalyst is coming. It might be Blackwell shipments accelerating, it might be a new hyperscaler announcement, it might be sovereign AI deals, but it's coming. Nvidia at current levels isn't a screaming bargain. It's a reasonable price for the most dominant company in the most important technology trend of the decade. The risk? Customer concentration. A meaningful chunk of revenue comes from a handful of hyperscalers. If even one of them dials back capex, the stock reacts violently. The action? Hold if you own it. Accumulate on 15% plus pullbacks if you don't. Don't chase strength. This is the one. The name almost nobody in financial media is talking about right now. And honestly, it might be the most interesting setup on the entire list. To understand why Amkor matters, you need to understand how a chip actually gets made. There are 3 stages. Design, that's Nvidia, AMD, Intel. Fabrication, that's TSMC. And packaging, that's the step where the finished silicon gets assembled into the final product that ships to customers. For most of semiconductor history, packaging was the boring, low-margin step at the end. You wrapped the chip in a protective casing, shipped it out, collected your modest fee. Nobody cared. That's over. Modern AI chips are too complex to fabricate as single pieces of silicon. Instead, TSMC produces what are called chiplets, smaller individual pieces that have to be precisely assembled together like Lego blocks into the final chip. That assembly process is now one of the most technically demanding, highest value steps in the entire supply chain. It requires specialized equipment, advanced interconnect technology, and real engineering expertise. Amkor is the dominant Western player in this space. They are the second largest outsourced semiconductor assembly and test provider in the world. They just built a massive new facility in Arizona, 7 miles from TSMC's new fab. Same supply chain, same customers, same growth wave. The stock has moved sharply over the past month, but it's still trading at a fraction of the multiples assigned to the chip designers. That gap closes as the market figures out that packaging is the new bottleneck. The risk? Customer concentration and capex intensity. Building advanced packaging capacity is expensive, and Amkor competes with ASE, the larger Taiwanese player. Margins could compress if pricing power doesn't materialize as expected. The action? This is the asymmetric play on the list. Smaller market cap, less coverage, more room to run. Build a position deliberately on any weakness. Step back from the individual names for a second and look at what we just covered. 5 companies, 5 different layers of the same supply chain. TSMC fabricates, Amkor packages, Intel, AMD, and Nvidia design the chips that flow through both. Every dollar of that $750+ billion in annual hyperscaler capex has to pass through this group to actually become functioning AI infrastructure. If I had to rank them by conviction for someone building a position today, TSMC, the foundation. Own it or own nothing. Amkor, the asymmetric setup, most upside if the thesis plays out. AMD, the dual exposure. Wins on CPU and GPU. Nvidia the incumbent. Boring but reliable. Intel the comeback bet. Highest risk, highest reward, smallest position. Investing isn't about finding one magical stock that 10x's overnight. That's not investing, that's speculation, and most people who try it end up worse off than when they started. Real wealth gets built by understanding businesses, paying reasonable prices, and being patient enough to let the thesis play out. This is my list based on my research. Your situation is different from mine. Your time horizon, your risk tolerance, your existing portfolio, all of it matters. Always do your own homework before you put real money to work. Nothing in this video is financial advice, and I'm not a financial advisor. Before we wrap up, quick disclaimer, this video is for educational purposes only. I'm not a financial advisor, and nothing here is financial advice. Always do your own research, understand the risks, and invest responsibly. Markets can go up or down. That is the real SpaceX trade. It is not waiting for the IPO. It is positioning in the infrastructure that makes everything possible before the rest of the market catches on. If this video gave you a new way to think about what is happening in the market right now, do me a favor and share it with someone who needs to hear it. Drop a comment below and tell me which of these 5 stocks you are most interested in. I read every single one, and if you are not yet subscribed to Stock Pulse Alpha, now is the time. Hit subscribe and turn on notifications so you never miss when we drop content like this. We will see you in the next one.